Hello and welcome back to my channel. Delving deeper into the global marketplace and how the economics affect all of us, not just folks on one side of the planet or the other side. So inflation is back. I know. You're shocked. Truly. After everything we went through together, the pandemic, the supply chain meltdown, the great egg shortage of 2022. Years of central banks raising rates to levels nobody had seen since the early 2000s. After all of that, we thought we'd earned some peace. We thought we'd actually beaten the thing. We had not beaten the thing. Because here's how inflation works. You don't beat it. You suppress it. You hold it down with high interest rates and tight money and the quiet misery of slowing growth, and eventually it stops squirming and you let it up. And sometimes it stays down. And sometimes a war breaks out in the Middle East and shuts off a fifth of the world's oil supply, and it's 2022 again, except nobody's pretending to be surprised. Let's talk about where we are, how we got here, and who's going to pay for it, because spoiler, it's not the big institutions or countries that are best positioned to absorb it. It'll fall on ordinary people, low-income economies, and energy-importing nations with no cushion. The numbers according to the IMF. Let's start with the International Monetary Fund, because they publish a report called the World Economic Outlook, the WEO, 4 times a year, and the April 2026 edition is titled, Global Economy in the Shadow of War. That's not a metaphor. That's a subtitle the IMF chose. For context, this is an institution that normally titles its reports things like, Navigating Global Divergences, or Steady but Slow. Shadow of War is practically a horror film by their standards. Here's what's in it. Before the Middle East conflict broke out, before the Strait of Hormuz closed, before critical energy infrastructure in the region took serious damage, the IMF was actually feeling pretty good about things. Global growth was running around 3.3%, and they were looking at upgrading their projections going into 2026. That's a quote from Pierre-Olivier Gourinchas, the IMF's chief economist, at the April 14th press briefing. Upgrading. They were going to tell everyone things were getting better. Then the war happened. Under what the IMF calls its reference forecast, the optimistic one, the one where the conflict stays short-lived and contained, global growth falls to 3.1% this year, and global headline inflation rises to 4.4%. Gourinchas called that a sharp departure from the previous trend. The IMF's own words for the report's theme are that the global economy is, quote, again disrupted, with rising commodity prices, firmer inflation expectations, and tighter financial conditions testing the recent resilience. And that's the good scenario. The IMF also built 2 others. In the adverse scenario, assuming a sharper energy price spike and rising inflation expectations, growth falls to 2.5% and inflation climbs to 5.4%. In the severe scenario where energy supply disruptions extend into next year and financial conditions tighten sharply, global growth drops to 2% this year and next, and inflation exceeds 6%. 6%. We were celebrating when inflation came down to 4%. For reference, the IMF had the average oil price at $67.74 a barrel for 2025. Their April 2026 baseline assumption, the reference forecast, puts it at $82.22 a barrel this year. Their adverse scenario has oil prices increasing by 80% from January levels starting in the second quarter of this year. If that sounds familiar, it should. That's roughly what happened in 2022 after Russia invaded Ukraine, and we all remember how that felt at the gas pump. How energy becomes everything. Here's the thing about energy shocks that makes them so infernally difficult to deal with. They don't stay in the energy sector. They travel. The IMF outlines 3 channels through which this particular shock is spreading, and it's worth going through all 3 because each one is worse than the last. Channel 1 is the obvious one. Higher commodity prices are what economists, with characteristic understatement, call a textbook negative supply shock. When energy costs go up, the cost of producing and transporting everything goes up. Food, goods, services that require heat, power, or movement. You pay more at the pump, more at the grocery store, more for a plane ticket. Your heating bill goes up. The restaurant you like raises its prices because their food delivery costs went up. That's channel 1. It's direct, it's immediate, and most people feel it within days of an energy price move. Channel 2 is where it gets harder to stop. When firms and workers start absorbing higher energy costs, they try to recover their losses. Firms raise prices to protect margins. Workers demand higher wages because everything costs more. And then firms raise prices again to cover the higher wages. Economists call this a wage price spiral. The IMF flags this as a serious amplification risk, especially, and this is important, in places where inflation expectations are, quote, poorly anchored. That's a very diplomatic way of saying, in places where people have recently watched their central banks fail to control inflation once already, and aren't sure they'll manage it this time either. Channel 3 is the one that keeps finance ministers up at night. If inflation expectations start drifting upward, if markets start to believe that this time, central banks won't or can't bring it back down, you get a sudden repricing of financial assets. Lower equity valuations, higher risk premiums, capital flight away from emerging markets, dollar appreciation as investors run for the traditional safe haven. The result? Financial conditions tighten sharply, credit gets harder to get, investment falls and growth slows, not just in the countries directly affected by the energy shock, but everywhere those financial conditions reach, which is most places. 3 channels. All of them running simultaneously. And as the IMF notes, the supply curve that policymakers are now working with is, quote, much flatter than it was during the 2022 inflation surge. That's a technical way of saying, central banks trying to bring inflation down this time are going to have to cause more economic damage, more unemployment, more slowed growth, to get the same result they got last time. The tool still works. It just costs more to use it. What central banks are actually doing. Which brings us to the central banks, because their response to all of this is, and I'm being charitable here, a masterclass in institutional hedging. The Federal Reserve, as of its meeting ending June 17, left interest rates unchanged at 3.5 to 3.75%. The FOMC minutes from the April 28 meeting explain the bind therein with unusual clarity. A model-based breakdown of what's happened to the 2-year Treasury yield since the conflict began shows, and I'm paraphrasing their language, a sizable increase in expected inflation, partially offset by a decline in the expected real rate, which they note is, quote, a combination consistent with the realization of an adverse supply shock. In other words, the market knows this is an energy shock, not a demand shock, and is pricing accordingly. The Fed's problem is that monetary policy doesn't distinguish between those two things cleanly. Raising rates cools demand. It does not increase oil supply. It does not reopen a closed strait. So the Fed is sitting on its hands, not because it's lazy, but because the standard tool for fighting inflation actively risks making the other part of the problem worse. Slow the economy to fight inflation, but the economy is already slowing from the energy shock. It's the policymaker's version of being asked to fix a broken leg by breaking the other one. Vanguard described this situation in their April 22 analysis as a classic stagflationary shock, and noted that central banks find themselves pulled in opposite directions. Higher inflation implies tightening. Slower growth implies easing. The Fed for now is doing neither. The European Central Bank story is somewhat more dramatic. The ECB spent most of 2024 and 2025 cutting rates, 8 times in total, bringing the deposit facility rate from 4% down to 2% between June 2024 and June 2025. A careful, successful, hard-won disinflation. And then on June 11 of this year, the ECB raised rates by 25 basis points. The first increase since 2023. Because the energy shock made it necessary, and headline inflation in the Eurozone is now projected to hit 3% in 2026, up from an earlier forecast of 2.6%. To be clear, the ECB cut rates 8 times. Then raised them once. Because the war showed up and undid enough of the progress to require reversing course. If that sounds exhausting, it's because it is. ECB meeting minutes from April noted that several council members viewed the decision to hold rates that month as a close call, that they would have supported a hike then, and warned that the energy-driven supply shock was proving more persistent than previously expected. The Bank of England is holding rates at 3.75%. UK inflation is running at 2.8% as of May, above the 2% target, and the bank has revised its forecasts upward. Before the conflict, the bank expected UK inflation to settle near 2% through the rest of the year. Now it's projecting something like 3 to 3.25% in the third and fourth quarters. 3 major central banks, 3 different positions, 1 shared problem. They are all trying to control an inflation that began with a war they cannot fight, a supply disruption they cannot fix, and an energy price they cannot set. Who pays and who doesn't? The IMF, to their credit, is unusually direct about the distributional question. Who this actually hits hardest. The report's language is precise. Pressures are concentrated in emerging market and developing economies, especially commodity importers with pre-existing vulnerabilities. Low-income energy importers are described as highly exposed, especially those with limited buffers. In sub-Saharan Africa, the IMF projects median inflation rising from 3.4% in 2025 to 5% in 2026. In the Middle East and North Africa region, ground zero for the conflict itself, the IMF revised cumulative growth downward by nearly 3 percentage points for 2026. Energy exporters, by contrast, are doing fine. Brazil, for instance, a net energy exporter, is actually benefiting from the higher prices this year. The IMF upgraded Brazil's growth forecast. Saudi Arabia, the UAE, and other Gulf states producing the oil that everyone else is scrambling to find alternatives to, are structurally on the right side of this shock. So here is the distributional picture the IMF is painting in plain English. The countries least responsible for either the war or the global energy dependency that makes them vulnerable to it are paying the steepest price. And the countries exporting the commodity whose supply disruption caused all of this are largely doing fine. That's not a conspiracy. That's just geography and energy economics. But it is worth saying out loud because a lot of the policy discussion focuses on what the Federal Reserve is going to do next, or when the ECB might cut again, as if the headline number that matters is the 4.4% global average, not the 5 or 6% that lower-income commodity importers are actually living through. The just wait strategy. The IMF's advice to central banks, delivered by Gourinchas at the April press briefing, was roughly this. For now, you can afford to wait and watch, provided inflation expectations stay anchored. But you need to be prepared to act, communicate clearly that you're prepared to act, and actually follow through if expectations start to drift. That's reasonable advice. It's also advice that depends heavily on one assumption holding, that people, firms, and financial markets believe central banks when they say they'll act. And here's where the 2022 experience casts a long shadow. The IMF flagged this directly, noting that the last episode left scars, and that higher prices raised cost of living concerns and made inflation expectations potentially more sensitive to new price increases. Translation: we went through a major inflation shock not 3 years ago. The public has not forgotten. Workers negotiating wages have not forgotten. Companies setting prices have not forgotten. So when inflation rises again, even for a genuinely different reason, the institutional credibility that took years to rebuild starts getting spent faster than it would have a decade ago. Central banks, in other words, are not just fighting this energy shock. They're fighting the memory of the last one. And the tool they used last time, the blunt instrument of higher interest rates, is sitting right there. Expensive, uncomfortable, but very real. Too close with my thoughts on this for now, and to answer the question, so where does that leave us? The IMF's reference forecast, the optimistic one, assumes a short-lived conflict, a moderate 19% rise in energy prices, and a global economy that absorbs the shock without things getting dramatically worse. Under that scenario, the damage is real but manageable. Slower growth, elevated inflation through this year, a gradual return toward target in 2027. Under the adverse and severe scenarios, longer disruption, higher energy prices, less anchored expectations. You get something that looks like a genuine global recession combined with sustained inflation above 5 or 6%. That's not a prediction. It's a risk distribution. But it is the risk distribution the IMF built out, named and published. Not fringe analysis. The house view of the institution whose job is to monitor global economic stability. The deeper issue, as I see it, isn't whether the central banks can handle this specific shock. It's that the global economy has now had 3 major inflationary episodes in about 15 years, 2008, 2021 to 2022, and now 2026, each triggered by a different kind of supply disruption, each requiring central banks to do painful things, each costing the most in the places with the least cushion. And after each one, the conversation focuses on when rates will come back down and growth will recover, not on whether we've built any structural resilience against the next one. The IMF mentions energy security explicitly, urging countries to invest in renewables as a hedge against future supply shocks. Gourinchas said so directly at the April press briefing. It's buried near the end. It always is. The next shock will come from somewhere. Energy, supply chains, climate, conflict. The specific trigger will be different. The mechanism, a disruption in global supply transmitting immediately into commodity prices, traveling through wages and prices and financial conditions into the real economy of people buying groceries and paying rent, will be the same. Inflation is not a mystery. It's a bill. The question is always who signed the contract, and who gets handed the invoice. That's the show. I'm citing everything in the description, the IMF April 2026 World Economic Outlook, the FOMC minutes, ECB statements, and the Vanguard analysis, because this stuff is real, it's documented, and you should be able to read it yourself. See you next time.